Are stocks cheap? Are stocks cheap at 17.5 or 18 times earnings, better known as PE, price to earnings? Well, different strokes for different folks, I guess. We got two gurus giving completely 100% diametrically opposed advice.
Ooh.
So, and the R word's being thrown around everywhere. Recession, not a recession. Are we in one? Are we not in one? And we're going to get into that, as well as Michael Ramos's leading sector, the big fundamental story he's found this week that looks like it may have some long-term legs. And then we're going to talk about his football, not football, not soccer, but American football.
American football.
With the pigskin.
Yes, of course.
And it's actually going to be fantasy football.
Oh.
He's going to step into Alex's shoes and Hunter's old shoes.
Yeah.
And taking a shellacking from Don. At least Don's hoping. I'd like to see an upset. I'd like to see him step in and
would you
take
now,
Don's
Danny?
Yeah, I
Would you
would.
now?
Oh,
You like that?
You don't even know. I'm going to help recruit for him.
Yeah, then he's surely doomed then.
Anyway, and we're also going to introduce our new intern analyst and his background. But first, we have a huge announcement at Revere. That's besides the new analyst, Ted. Besides Ted, we are now SEC registered.
Ooh.
Yeah, I put it off as long as possible, but we
Hey.
really had to do it. We got above the $100 million mark, and they always let you have a little bit of wiggle room because, you get above there. And if all of a sudden you do it at 105 or 110 million and the market pulls back and you shrink down a little bit where you're supposed to go back to the state and it gets kind of expensive. So they kind of let you give you a little buffer and let you get up to, 110, 115. But after that, we're well above 120 now and, approaching 130. And so it's kind of a little bit hard to not do that. But
Interesting
anyway,
how that downside protection keeps your AUM
up,
there,
yet
huh,
you
Dan?
don't have the roller coaster. I like it.
That's correct.
That's actually very good. Now, before and with going to the SEC comes more compliance and regulation and more stuff. And so with that, I have to read the disclaimer
Yes.
before we go on about this SEC registration. Your Money Radio podcast covers general topics and investment ideas for research. It is for education and entertainment purposes only. If you want or need individual advice, please seek your own investment advisor or seek out one of us at Revere. We would be happy to talk to you, talk to you about the market stocks, whatever you would like to do. You can email any of us, Dan at revereasset.com, Don at revereasset.com, or Michael at revereasset.com. You can also call us old school at 855-REAL-WEALTH. Or for more information, just go to revereasset.com. All right, house cleaning is over. We're done with that. Okay, so now we are going to SEC registration, which actually makes it much easier, because before, we're registered in state, you're licensed by the state, your primary business in, and then you can go to each state. You can have clients in other states.
Yes.
But as you get 5 or more clients in each state, husband and wife counts as one, right?
Mm-hmm.
You've got to get registered in each one of those states. Is that the White House calling, Don? Asking for some economic input?
He's sort of right now.
Are 2 quarters of declining GDP a recession or not? Anyway. So the SEC, but speaking of the SEC, but if you get more than 5 or more clients per state, then you've got to get licensed in each one of those states. And so we're already licensed in like 5, maybe 6.
I was going to say, yeah.
I've got a compliance company that keeps me compliant. But anyway, and so it makes it a lot easier because now we can just do one big blanket registration and we're done.
That is nice.
You don't have to do all the, yes.
Well, congratulations.
It is, but they are a little bit more, I guess the best word is organized. They're just more fit, yes.
Okay.
And you will get audited in the next year or two. And in our business, that's a good thing because you want to try to, keep everything on the up and up.
But, of course.
But I saw this article and I thought it was apropos because we're going to talk about SEC registration, right? And the SEC, this is the title of it, and all these articles are in the footnotes. In the footnotes of the show. So if you want to do your own research, you can go read any of these. But the SEC is scrutinizing scrutinizing RIAs, that's registered investment advisors, that's us, for remote workers for possible violations. Well, they got to do that, remote workers, because since COVID, everybody was working remotely. They can't do, non-remote because nobody's at the office, right?
Right.
So anyway, but it says the SEC is zeroing in on ethics, best interest, and failure to supervise violations. And it's particularly acute with advisors with multiple branches and with different operating procedures among the branches, and advisors that work remotely and have their own book of business, meaning they are doing their own thing and managing. Mm-hmm. And they give a few examples, and one guy was kind of cherry picking and giving the best execution for his own family members and his preferred clients, and giving a worse execution, meaning worse price when he bought stocks for his less favored clients. That's known as cherry picking. Okay. Got a big fine. So anyway, it says failure to oversee portfolio management practices, billing, and trading is really the three big areas. Now, and that give me a big sigh of relief, because I went, well, good deal. Because we do everything in block trades. Everybody gets the same average price, including Don and me. We're right in there with our clients.
Yeah.
So we do everything at the master level, and everybody gets the same average price at the same timestamp. So there is no front running, cherry picking, whatever. We do all, even though we are very horizontal, we're spread out geographically, which actually turns out to be a good thing, because if we have like the ice storm in Texas we had a year and a half ago, Don's in Florida ready to run the show. When Don has to leave his beach palace because of a hurricane coming in. Then we can run the show here, right?
Yeah.
And Michael's out in California, so we've got like redundancy and backup.
Yeah.
But the other thing is, we also don't, because they were worried about custody, we don't custody clients' assets.
No.
You're either Schwab or TD, okay? And we do all the billing centrally. So we won't really access sensitive information. That's what they're really worried about. Mm-hmm. That's really kind of housed at Schwab and TD. And as long as I have my laptop, and I'll tell you, you got multi-factor authentication, all that kind of stuff. So this actually made me feel really good, because I don't think we're going to have any problems, but you never know. You always got to wait and see what they want to bring up.
They're a funny organization.
You got it. Now, they are a necessary,
Yeah,
it's like, government's a necessary evil. That's all there is to it. Yeah. All right. Now, but I do want to get into this topic about, are stocks cheap or not? Are we in a recession or not? Now, Jeremy Siegel, who's well known, and I believe he's the one. Yeah, he teaches at Wharton School of Business. He's basically coming out and saying stocks are cheap if you're a long-term investor. Stocks are cheap. Buy them now.
Okay.
Load up the truck and buy them now. Now, he goes on to, and he makes a comparison about, even with raising rates a little higher, right? Stocks are still more attractive than bonds. Bonds still aren't that attractive. Okay. Now he says, this is pretty, he goes, I think June was the market bottom. Then he gives his little disclaimer, next sentence, we might test that bottom, meaning it might pull back again, but he thinks we're near a market bottom, and it is time to load up the truck and buy stocks. The one thing that is good in this article that I did like is that he did note, because he's talking about the Fed and thinking the Fed is probably going to ease a little bit. The Fed is not going to need to be as hawkish as they were, because the numbers are starting to show slowdown, recession.
Yeah. So
he thinks that even though they are talking really tough right now, they may not be, and he still thinks they're going to raise another 1% by the end of the year. He did have an interesting note on here that I like the reminder. I knew about it. A year and a half ago, the Federal Open Market Committee members, the Fed members, over half of them did not believe there would be any need to raise rates in 2022 because inflation was tame.
Sure.
Boy, they were wrong. Even the most hawkish member only thought the Fed would have to raise points, interest rates by 50 basis points. That's 0.5, a half a percent. Okay. In actuality, they have raised it this year to date 2.25%, 225 basis points, or well over 300% more than they anticipated. So their rate increases were much, much bigger than even the estimate. I mean, like triple, quadruple. So it's obvious that the Fed is really not a very good we're relying on the Fed for all these forecasting and monetary policy rules, and they're wrong consistently. So I don't know why it's like the politicians in office. It doesn't matter which side you're on. They keep lying to us. Why do we keep voting them in?
Yeah.
Let's get rid of all the incumbents. Anyway, I won't go down that rabbit hole. Anyway, so he is basically saying it is time to load up the truck. Now, contra to that, Gary Shilling, who's an economist, and he's traveled the CNBC circuit. He's
Gary
out there.
Shilling, yeah.
He says that Wall Street is in denial. That everybody knows the economy's weak, but he's saying it's really weak once adjusted for inflation. He said, yes, nominal pay is up 8.8%, but if you adjust it for inflation, actual pay is actually down a couple percent. You haven't kept up with inflation. He said consumer spending and retail sales, even though it showed 6.9, the real inflation adjusted is negative 4.1. So we've actually spent 4% less, and you can kind of see that in Walmart and some of these retail sales numbers. Also, he said that Wall Street earnings estimates by all the analysts on Wall Street were supposed to be 5% this year. He said, but when you adjust it for inflation, it's actually slightly negative. So earnings on a real term are actually going down, and we're losing ground. We're falling behind. He also talks about consumer spending, but the whole point is that he's saying that inflation could be a lot more insidious than we believe, and that it's hurting companies, it's hurting company profits. And he wanted to remind people that during the 70s, even though the Dow stayed around that $1,000 level, once you adjust it for that whole decade, it lost over 70%. So anyway, the whole point is he's saying that you need to batten down the hatches. Now, here is my thing. This is why it's so key. By the way, we were talking about both of these topics months ago. So I'm glad they're finally welcome to the party, but that's why you got to separate Wall Street from Main Street. Those don't always go in tandem. There's been lots of studies showing long-term correlations with the overall economy and the stock market on earnings, but in the short term, those correlations break down, and it's a lot harder to determine what you got to do. So I agree with Gary Shilling. The economy is very weak, and we are going into recession, and things are negative when you adjust for inflation. I agree just very short term with Jeremy Siegel that stocks are kind of looking attractive just these last 2 days. Last week they didn't, right?
No.
But long term, I'm not willing to buy anything long term at this point. I mean, I don't know. Jeremy's got a lot more courage and conviction than I do.
Yeah.
So in any event, Don, I want to get your thoughts on both of those. I'm actually going to get Don.
You already know the answer to this, don't you?
I know. But I love setting you up for this.
I'm a broken record when it comes to this. Zach, can you show the chart?
Absolutely.
Yeah, that's my answer. Whatever is reflected on this as time unfolds is honestly all that matters. The opinions of either of those two esteemed gentlemen that you mentioned don't matter. My opinion doesn't matter. Nobody on this podcast's opinion matters. Nobody's opinion matters. The only thing that matters is how price and volume unfolds down the road on this chart. That's how we make our decisions, no matter how bleak or how bright the forecast might be. They say Wall Street always climbs a wall of worry. There's a lot to worry about right now. But is it any different during this uptrend than it was during this downtrend. And now are we starting another uptrend? That's not for us to decide what's baked in, what's not baked in. But all week, Fed officials have been coming out and saying, we're not kidding. This time we mean it. We're really not backing off rates. And all the market did was respond with a 3% rally this week on the heels of this big negative down day on 8/26. We closed. This was the Jackson Hole speech, a panic selling. We closed at 40.57. Right now we're at 40.62. So 4 or 5 days down. Couple days along the bottom at 3,900. This is our third day up now, clearing two moving averages. The intermediate term line, that's the red line, the 50-day moving average, and our short-term trend line, the 21-day exponential moving average. And this is where we take our cues as far as what's healthy and what's not healthy over 3 time periods. Now, long-term, the foreboding black line that's declining, that's the 200-day moving average. That's where we failed on 8/16. That started this most recent leg down that was accelerated down by the Jackson Hole speech. But we're right back to where we were in the close that day. So all of this additional selling has been undone by this buying this week. It's very clear what the Fed is doing. Jerome Powell made it clear on 8/26. Every member of the Fed that's spoken has supported that over the last 2 weeks, and the market has just decided to rally after a break on 9/6 this week. So that was Tuesday, right when we came back from Labor Day. All the traders streak up back, and the market has rallied this week, despite the fact that this is a seasonally very weak period for the market. I'm not saying we're going higher. I'm not saying we're going lower. I'm saying we will take our clues from the price and volume action of leading stocks and of the indexes. And that's all.
And I will say one thing.
Nothing else matters. One
thing on that chart that I keyed in on right away. So the 50-day, which is that red line, right, Don, is starting to, the slope is starting to pick up, it's starting to angle up positive. But that 21 exponential, which is the green, which was coming down, which a negative slope is bad. That means prices are going down. Okay, it's starting to flatten out. If that continues, that's bullish, and if it starts to turn up, that's really bullish. So
I just made that exact change on the tail of the tape for tonight's video, and
damn, I'm a damn genius.
That's one of the things that we'll be highlighting.
All right. So anyway, folks, the whole point is, and we beat this every week. We beat this like a broken record. Don't listen to CNBC. Don't listen to Bloomberg. I mean, it's good as a research tool to find some kind of theme or whatever, but it's not good to help you make money. A lot of times they come up with stories after so the market was selling off just a week ago, and they came out with all these stories right after that the next day because they got to fill their periodical, their newspaper, their television show, and they come up with stories why the market sold off. Now it's starting to rally, so now they're starting to backfill stories about what the bullish story is. So a lot of times they write the story to explain what just happened, whether it's right or not. Okay?
Right.
That's one thing you can't rely on because it's old news. It's history. Okay? And number two is forecast going forward when they say, I think, 6 months or 9 months or a year out. That's too dangerous. And by the way, some of the best leading indicators 6 to 9 months out is the stock market.
Yes.
So when Don was saying price and volume, price is truth. So that's what we're going to try to key on. It doesn't matter what any of us think. So, all right. And I know we go over that a lot, but we got a lot of new listeners coming on board all the time. So we want to reiterate that. All right. Now, so before we get into Michael's fundamental sector and his football, not football, okay, I want to introduce our newest analyst, intern Ted Zhang. And Ted is actually a senior at William and Mary, man, who was going, maxillofacial surgeon or dentist. I mean, biology major. He was doing research on DNA and all kinds of complex stuff. But then he got the trading bug about 2 years ago.
Oh,
and
Ted,
anyway,
I'm so sorry.
I will let Ted give his background in history. So, Ted, welcome to Revere.
Thank you, Dan, for having me. So my name is Ted. I am from Vienna, Virginia, a suburb outside of DC. And yeah, like Dan said, I'm a current senior at the College of William and Mary. Coming to college, I was a science guy. I was pretty much dead set on dental school and maybe oral surgery. That's something I would have decided in the future. After the COVID crash, spring of 2020, my friends who were already in the markets introduced me to the markets. And ever since then, I think it's about 2.5 years now, I haven't missed a day. I'm also an O'Neill disciple, Stan Weinstein disciple, and Minervini disciple. I've read their books. And so after about a year, I started tweeting and sharing my thoughts on Twitter. I've gained a decent following. And from that, I secured an opportunity at Trader Lion over this past summer. And I worked on Stan Weinstein's course with them. And that was a great experience. And then luckily through that, I was able to reach out to Don, and now I'm here, and I'm really excited to be here.
Well, you obviously impressed Don quite a bit, because he called me up and said this kid's for real, and he said the same thing with Michael. Michael's a little bit older, but because Don vetted like 30 guys.
I remember you saying that.
Oh,
yeah,
and some of them.
people,
we put out the social media thing, and we got 30 plus people now. About half of them you could quickly go and say no, because these guys were
right.
Like, oh, I'm interested. I'd like to learn. Can I be? Well, we don't have time to train.
No.
They got to hit the ground
We
running.
need the varsity squad.
They've already got to have a lot of experience. But then he went through guys that were seasoned with 10, 15, 20 years experience. A lot of times those guys are too set in their ways, or they're a one-trick pony where they're just doing Bollinger Bands or whatever. And they're not pliable. You got to be flexible in your mind that the market could go up and go down.
That makes sense.
Anyway, so Stan Weinstein, Ted, you actually work for him. Is he the one that does the stage analysis, or which one? What?
Yes, he coined the whole concept of stage analysis.
Right.
And I definitely think that's one of the most revolutionary concepts for me, just analyzing the price and volume action in the markets.
Okay. Who do you? So just I'm going to put you on the hot seat here.
Uh-oh.
Who do you like more, or who do you try to emulate more, Stan Weinstein or Mark Minervini? That's a tough call.
Definitely, I think Mark Minervini, but so he's a pretty short-term trader.
Yep.
I would say I aim to be in between O'Neill and Minervini.
Okay.
Yeah.
So you've got what you're graduating this spring, right?
Yeah.
And so now you have made the formal decision that you're probably not going to dental school.
Yeah, exactly. So yeah, it's going to be a tough decision, but I've definitely been thinking about it for the last few months. Yeah, I think so.
Well, that's awesome. Well, anyway, you've got a really impressive resume, and Michael, played a lot of competitive soccer too. You did also. Mm-hmm. You were on a couple state championship teams, I guess, in high school, and you played in the Nationals, and you're still active in college, right?
Exactly. So freshman year of high school, I went to Shattuck St. Mary's in Minnesota, and it was a development academy team. And so I went there for boarding school. It was very expensive, and the education was pretty much the same level as Nova. So I decided to go back home, and I played for McLean. And we went to the national championship. We played in the National League. In high school, I was the captain of the varsity team, and I also got Conference Player of the Year my senior year.
Well, good deal. Well, when we have a Revere annual event, I may have to bring a soccer ball and have them square off against each other.
Our Revere intramural annual soccer match. Is that what you're saying, Dan?
Yeah. Well, we'll start a fantasy. Yeah. Is there a fantasy soccer league, like fantasy football?
Oh, of course there is.
So, well, I figured there would be, because soccer's huge now. Yeah. It's growing. My kids are all into soccer.
Yeah, soccer's huge. We'll do Dan and Don versus Michael and Ted.
Ted worked with Richard Moglen, who the interview that I had with him is very responsible for us reaching an entirely untapped audience prior to that interview. And Richard and Ross, who's another one of the guys that works there at Trader Lion, they wholeheartedly recommended him to me. And Ted, did you know that Richard interviewed me before you reached out to me?
Yes, No, I actually didn't. No, I didn't. So
How about
I was
that?
quite surprised, and then I watched the
Small
interview.
world.
Yeah. All right. Well, we're expecting great things from Ted. So Ted, no pressure. Just bring your A game.
Yeah, you'll be all right.
We're going to let him give us his thoughts on the market in just a little bit.
Yeah.
Along with Don and Michael. All right. Now we're going. Oh, before we get into Michael's sector this week that he's uncovered, I want to know, Michael, how you are going to compete in Don's fantasy football league. Have you guys even divvied up and picked players yet? What are you guys doing?
Michael, do you want to tell them how much ass I kicked last night, or do you just want me to tell them?
Yeah. So,
oh no.
I'll tell him because it sounds more legit coming from me. It's true. And by the way, sorry, I just want to let you guys know the gardeners come every day or every Friday at this time. So
Might hear some
I'm gonna
noise.
do my best to try to mute myself if my dog's barking, because they do a lot of loud stuff in the garden. So excuse that, please. I think they've moved on from my section, but just want to let you guys know that.
My butler almost
yeah.
has my lunch ready too. So when
Appreciate it. What happened last night?
Tell your wife I said hello, Don.
So yeah, I was very impressed with Don's results yesterday. My team, I had one player who played yesterday and doesn't look like he was involved much in the game, so I got 0 points, and I was thinking, oh well, everyone probably only scored a few points on the first day, but Don had like 40 points on the first day, which I think sounds like a lot. I think that was a
47,
very high scoring
but
day.
you know who's counting? I drafted
So
the
yeah,
combination of Josh Allen, Bills quarterback, and Gabe Davis, Bills up and coming future star receiver. So great start to the season for me with last night's game. Now, I also want to mention to you, Michael, something that I had to break to Hunter last year. I've been playing fantasy football longer than you've been alive. I started in 1990 was our first year. So this is our 32nd year playing fantasy football. Just me and another guy are the original members. We've got 10 teams. We've had a bunch of guys come and go. But year number 30, actually number 33 this year, which makes me feel extremely old. We used to this is back in the days when we used to have to calculate the scores by getting up early Monday morning, getting the newspaper out of the driveway and going through the box scores that were printed in the newspaper to try to calculate the points. A lot easier now with all the websites that are so prolific all over the sports world.
Kids these days.
Does it for you.
So pressure's on you, Don. I'm clearly not expected to do very much, so I like being in that position. So less stress.
Good disclaimer.
Yeah.
All right.
It's one way of looking at it. Ted, are you an NFL fan?
I am not a football fan.
You're not an NFL fan? Well, you will.
I'm a football fan.
You will be by the end of the year.
He's a football fan.
Football, yeah.
Hey, I have a question for you both about soccer, because my daughter and I were talking yesterday. Her boyfriend's a huge Ronaldo fan, right? He's an awesome soccer player.
Yeah.
Like some people say he's the greatest of all time. That's what she was saying. Her boyfriend was saying. I said, I don't know. It's tough to compare eras, because what about Pele? I mean, he was good.
Is he better than Messi? I mean, I don't know a lot about soccer, but I thought Messi was kind of seen as the greatest current player. Or is he a little past his prime?
Messi is my GOAT, 100%.
Say that again. Who is Messi?
Messi is my GOAT, 100%.
What do you think, Michael?
What do you think?
Michael Stewart stuff.
I actually so I mean Messi's amazing. Messi's a legend, but I personally I would go with Ronaldo because just in terms of the Champions Leagues he won. I'm a Real Madrid fan, so he's done so much for our team. Sorry.
You're all right.
That's all right.
That is one handsome dog you got there.
Stella's great. Yeah.
Oh yeah, she's amazing. She's a beautiful dog, but she only barks with the gardeners when they're mowing the lawn. That's all she gets excited by. But yeah, so Ronaldo, I mean, I just think he's more of a like I look at Messi tactically and just like naturally is one of the most gifted players of all time. But Ronaldo, just his work ethic and the amount of effort he actually has to put in, like all of he's skilled naturally as well, but most of his game and his ability is from his work ethic, and he's just unrelenting, and he's an amazing captain and leader. And Messi is more of like a quiet, just not as doesn't have those same leadership characteristics. So I'd rather have Ronaldo on my team than Messi.
When I was
what is the history behind why the best player on the team wears number 10 on his jersey?
It's not always the best player, but it's usually like number 10. So historically, soccer teams, the numbers were by position, and number 10 was your center mid. So the center mid usually controls the gameplay, and you want a skilled player in that position, because that's where, like, for our team, Luka Modric is like our number 10, and he's amazing. And then Messi on Barcelona, it's like that sort of center mid skilled player. So that's why
Gotcha.
it's usually the number 10.
Oh.
Yeah, well, when I was probably in high school, I guess. Maybe it was college, but I was here playing a national tournament in Dallas, and that's when they were trying to bring American soccer, get American soccer going. Sure. And so they hired Pele because he was, but he was like 50. He was upper 40s at least. He had gray hair. Came out and he played, and he just went through 3-4 players at a time like they were nothing.
Yeah.
And then he actually did his trademark backflip where the ball's coming and he jumps in the air and kicks it with his feet upside down above his head. He was truly amazing.
Oh.
He was truly amazing.
Yeah, that's great. I could do that.
Sure. Yeah. No, you can't even do that in your dreams. All right. Now let's talk about Michael's sector that you think is very bullish, a little bit related to what you've been talking about the last couple of themes, Michael, but what do you got for us this week?
Yeah, so it's interesting actually. All the themes have been energy related, and involved in the like the first one is more, the LNG was more of a transition to this clean energy. And then lithium is involved in the clean energy revolution and electric vehicles. And now today, what I'm going to talk about is uranium and nuclear energy, which is, in my opinion, and a lot of expert opinions, the sort of final stage of like ultimate clean renewable energy. So, as I typically do, I'll go into a little background, and then we'll pull up some charts and a couple of companies that are or stocks that are positioned well. So as I said, one of the most compelling arguments for nuclear energy is that renewables like solar and wind, in addition to being inherently unreliable, like are very difficult to scale and incredibly resource intensive. So like I mentioned about the lithium, and that's a big component in battery storage, which goes into the solar industry. It's just extremely resource intensive, and a lot of those resources are scattered across the globe. So in terms of national security and securing those resources, there's going to be a lot of geopolitical risk and uncertainty going forward. So that should make it fairly difficult. And with nuclear, you don't have that issue per se. There aren't enough resources in the world to build enough solar panels, for example, at the moment. And even if there were, they're largely all controlled by China, which is a big issue for national security and geopolitical risk. strategically, it makes a lot of sense for the U.S. to use nuclear, as we've got a huge head start in that industry. I'll give a little background of nuclear tech in the U.S. The U.S. Navy launched its first nuclear-powered warship. It's called the Nautilus in 1954, and since then it's operated hundreds of nuclear reactors in some of the harshest environments on Earth. For example, in nuclear submarines and in all sorts of extremely tough environments. And we haven't had a nuclear incident. So in total, it's if you combined all the different reactors that the Navy's been running in the U.S., it amounts to thousands of years worth of safe nuclear operation.
Mm.
So what's good for us, and the reason why the U.S. should be very a firm proponent of nuclear energy, is the fact that we have the best tech and we have such a head start in the space, and amongst other things, which I'll mention in a second. But for example, the main nuclear incidents you think of, and the reason why public opinion is hesitant to embrace this technology, are 3 Mile Island, Chernobyl, and Fukushima. But those, if you look at the data, those are outliers, especially Chernobyl. And modern reactor designs are orders of magnitude safer than those reactor designs that had the incidents. And it also has to do with the location of those reactors, because the way that you create nuclear energy is through it's through heat. Just the nuclear fusion reactors create so much heat or sorry, I think it's nuclear. I think it's fission. Anyway, I have that written down.
Produces
But
heat. Yeah.
the heat that's generated it produces so much heat that you need a source of water to cool down those reactors. So that's why in Fukushima and 3 Mile Island they have them next to oceans or big sources of water, because that water then cools down the reactors. But now there's a new technology which is called small modular reactor technology, and that's a new development in nuclear technology, which now can make it more accessible and avoid a lot of these issues. And what SMRs do is they're a fraction of the size of a conventional nuclear reactor. That's why they're small. They're transportable and can be assembled in locations previously not possible. So now you can have a nuclear reactor in a really safe area that's not let's say it's not in an earthquake zone, or not in an area that can be affected by tsunamis or these harsh environmental conditions that resulted in these incidents in the past. Now you can have them sort of wherever you want, and they harness it's nuclear fission, yeah, to produce energy by generating heat, same as the other reactors, but they're just a lot smaller and transportable and more affordable, easier and faster to build. So looking into the SMRs as a future for this nuclear technology is a really interesting space. Um, and then one last thing I'll mention about nuclear energy is the biggest barrier for nuclear energy going forward at the moment, aside from public opinion, which is largely changing. If you take polls and just the way that people are talking about it, it seems that public opinion is really embracing nuclear and would actually like to see it take center stage. Um, but the biggest problem is actually overregulation. And if you look at the delta between the cost and time to build a traditional reactor in South Korea, for example, versus the United States, it's massive. It's just so much cheaper and easier to do it in other countries, and all of that, it's almost entirely due to overregulation. So if we do want to see nuclear and use it and embrace it, there's going to have to be a lot of changes in the current regulatory environment. And Japan about 2 weeks ago said that they're restarting their nuclear reactors. Actually, in California now, during this power grid issue and this heat wave, they restarted a nuclear facility, and they're the California, which is one of the most regulatory or difficult environments in terms of regulatory concerns, is beginning to embrace it. So that's a big step. for the U.S. in general. And then yeah, so a couple stocks now. What's difficult about uranium is because it's been in a such a long bear market, and it's just been so difficult to make money in that space for over 2 decades, really. It's hard to find quality names that are that have large market caps, that are priced well, and that have like the characteristics that you would need to see from in order for a fund like Revere to get involved in. But the first one, and really only one in my opinion, maybe there's others that I haven't found, but for the most part, the biggest, the leader, the largest market cap, and in terms of like average daily volume and liquidity, is Cameco, ticker CCJ. And disclaimer, at Revere, we started a position in CCJ yesterday, so we do own it. But if you look here in terms of so market cap, it's a $12 billion company, and the other ones are like the other uranium plays are a billion or less. They're all a lot smaller. It's got some institutional sponsorship with 36%. The earnings are increasing and set to almost almost triple in 2023 to 69 cents per share. The technical action looks good. As you can see, we hit a high in April at 32.50, pulled back to that $20 level, balanced, and it's kind of been hanging around that 200-day moving average. But on end of August, really, when you had that big volume spike, and we pushed above that 200-day, 50-day, and held above it, it pulled back to the 80 MA, and now it's been living above that moving average, which with a big increase in volume. So as long as that chart keeps shaping up, the volume patterns are correct, and we're above those moving averages, it makes sense to take a position and maintain it. So that's why we got involved in CCJ. And yeah, that's the only one I'm really going to mention for uranium miners, because it's kind of if you're a little smaller, you can take a look at UUU or UEC. The uranium ETF, I guess, is another play, URA. But yeah, UUU is $1.2 billion market cap. It's a $7 stock, low liquidity. URA is the only other way to really play it if you want something that's more liquid. This one is the uranium ETF, and it's a better way that you can play more of those names. The smaller ones, you don't have to worry about liquidity so much. So URA is another option, and yeah, and then in terms of the small modular reactors, there's not a lot of companies that are public yet because it's such a new space. A lot of them are private, but one of them is here. It's SMR, which is New Scale Energy. They took the ticker SMR for small modular reactor, but this is a very spec play at the moment. They don't have any earnings. They've got very little sales. I think, yeah, last quarter they had $3 million in sales, and they've got a $5.5 billion market cap. So it is priced very highly for that growth. But the only issue there is you've got to understand that it is speculative. If there's any regulatory issues or SMRs, there's a lot of reports that say SMRs actually produce a lot more waste than your traditional nuclear reactors. So it may be difficult for it's still totally unsure whether SMRs are the future, and whether it's a viable industry. So they are signing deals. They are making forging new relationships. SMR was actually a SPAC that it went public via SPAC. So which is a special purpose acquisition company, that corporation that anyway, you guys can look into that if you're interested. But SMR is a spec that could be promising going forward. And yeah, I think those are the only three names really worthwhile mentioning in this space, unless you've got other ideas. Don.
Yeah, URNM is another ETF. It's not as liquid as URA, and the charts are similar, but URA is by far the more liquid one. One of the big pluses for these companies this week was that the Green Energy Coalition in Europe decided to classify nuclear energy as quote unquote acceptable to them. So that's for a long time they were against it. I guess the realities of possibly freezing this winter because of no Russia gas coming from Russia is changed their minds a little bit, but that was a big step forward. And forever they've been opposing nuclear power. So you can get the Green Energy Coalition on your side. It goes a long way to it being more successful and more mainstream.
Well, I will say one thing. I think the green movement, this green movement, moving away from oil and gas, they've made their claim and they're not going to reverse on that. They can't go back and say, okay, let's start using more gas again or oil. So now they're going to start hitting the reality that there's not enough rare earth metals and lithium to actually meet the demand that they're actually regulating, both in Europe and California. California and Europe both said that as of 2035, there's no more gas-powered vehicles to be sold. You can only sell new electrics. And the problem with that is, if you look at the demand, you only have about 20-25% enough lithium or metals to meet all of that demand for the power. It's not, they're going at breakneck speed to a couple different energy, green energy sources that at this point the technology is not good enough to meet the demand, whether it's solar, wind, and electric, all three. And so now I think you're going to see them turning, kind of to save face, I guess, to turning toward nuclear and accepting that, like Michael just said, that Europe just embraced it, or John, is that you that just said that Europe is now, they put it on the green acceptable list. And that's really, and I think you're going to see a wave of that going across the world, because, people are not going to do without heat and lighting and all that kind of stuff. So I think it is good. All right. Well, Michael, I appreciate it.
And Dan, sorry, one last thing. Just piggybacking on what you just said about lithium and these rare earth metals not being as abundant or easy or as accessible as we really need them to for these renewables to take center stage. It's also, as I mentioned last week, with these most of these lithium reserves are in South American countries that just in terms of geopolitical risk, there's so much uncertainty there, and it's going to be very difficult. But it's not only lithium, for example, like I mentioned, bromine and cobalt.
Cobalt, nickel,
yeah, a lot of these other metals and materials that are essential for these renewable industries to work are in countries like, for example, the Democratic Republic of Congo has the largest cobalt reserves, and most cobalt comes from there. So that, like, a lot of these African nations are rich in these minerals that we need, and that is going to be an extremely tenuous and difficult situation to deal with going forward. China's already
moved in,
almost like they call it a sort of debt colonization, where they're financing all these projects and getting all the minerals. So it's almost like they're colonizing these African nations. And politically, they're so unstable. There's so much uncertainty. So as the demand and need for and reliance on these nations increases, it's not the best situation, and we can run into a lot of issues with that.
Yeah, and the other thing is, on these articles you said, I like those small what do you call them? Nuclear, not power plants, whatever you call them, nuclear. Because they're
modular reactors.
Yeah, these small reactors, you can actually put them in remote places, in rural places. So you can take them to where you need the energy you don't necessarily, you can have a lot of smaller ones spread out rather than having one big one in a single location. So it makes it a lot more efficient. All right. Thanks a lot, Michael. Before we go to Don to do his market review, I do want to go back to Ted, because I'm going to let Ted talk about a stock that he owns and that he's watching and looking at. Ted?
Yeah, so I picked up CEG, which is also in like this green energy theme. If you go on the weekly chart, I specifically liked how we had 3 weeks tight and it held a range of 1% while the market corrected about 10%. So that to me was a clear indicator that institutions were accumulating it, and I took it on September 7th as it was breaking out. And so this is like a purely technical trade. I don't know too much about the company, but yeah, that's one stock I own.
So
and then going off Michael's point, sorry.
Go ahead.
And go off Michael's point about the lithium in South America. So the daughter of the biggest Brazilian lithium mining company goes to my school, and my girlfriend's actually really good friends with her. So I just want to share that. That was interesting.
be careful with that inside information.
Know a guy
Ted.
knows a guy.
So
it's a small world after all.
Yeah. What's your do you have kind of a chart pattern you kind of lean toward? Are you like 3 weeks tight better than a cup and handle, or I mean, is there?
No, there's no chart pattern specifically that lean towards, and I think this is where Minervini's indirect mentorship has affected me. I want to look for volatility contraction patterns, and like you don't see cup with handles that often. So I just want to see tight price action. I want to see volume contract, which indicates that sellers have been exhausted, and therefore when demand comes in, we can see it like quick spike.
Big pop, yeah, big pop.
Yeah.
All right, Ted. Well, welcome to Revere. All right, Don. Let's do a quick market review.
Sure. Big change this week from last week, very clearly. So last week we had follow through to the downside after the 826 Jackson Hole speech by Powell put a pretty firm stop to the uptrend and any rebound that we were attempting to have after this nice move off of the lows starting in mid-July. But really what we've seen this week is just the opposite. If we go to smaller time frame chart, let's go to a 15-minute chart. And right here you can see a failed breakdown. This was on the 6th, so on Tuesday. The lows from last week, we had a little gap up in the morning and then we started selling off. We broke below this 3903 area from last week. But we didn't spend any time beneath there. We immediately got right back above it. That's what you want to see for a false breakdown. And that was really the last opportunity for any bears. They kind of punted at that point. You had this gap up on the 2nd, which was last Friday, which was looking extremely good. But we ran right into the 50-day moving average last Friday and had a very hard reversal off of that level, and it just looked like we were going to go to lower lows and continue lower. Very similar to what happened here back at the beginning of July. I remember this specifically on 7/14, thinking, man, this market is going to break down and go lower. But what happened is you had a false breakdown. You undercut the lows from these 3 days here, and you got right back above it, close at the top of the range, and that was it. That exhausted all the sellers. It seems like for now the sellers all got exhausted on Tuesday, and we've had the third up day, 3 up days now. The bears had an opportunity to take the ball back here at noon yesterday when we had some negative commentary coming out of the ECB. They did their 75 basis point hike in rates. We sold off very hard on above average volume, but that was it. We only got down to 39.54 and had a very strong bounce up for the rest of the day. We actually took a inverse ETF, a net short position at this point. It was very soon after that I realized that we're not going lower. The buyers came back in and we started trickling to the upside. So we That's when we took our CCJ and our ON positions, went sideways into the close, and then the gap up this morning, we got rid of the inverse ETF, and we've made 4 buys on SSO, all at increasingly higher prices as it's continuing to show strength. So we flipped to a 20% long position in SSO, and it's right where we want to get in, which is very close to these tight moving averages. If we break below today's lows, that means that this attempted rally is going to pause. At worst, we should pull back to 4,000 if we want to keep this little bit of a rally alive. I'm thinking similar to this action over here, 719, 20, 21. We had 4 days up strong. We had a sideways day as we started to consolidate some of those gains. We pulled back for 2 days, came right to the 50-day moving average, and that was it. We bounced and had the next 3-day up move, consolidated again, had another gap and had an up move before we ran into this declining 200-day moving average. So 3 days up now, maybe time to go sideways a little bit, but today's lows or yesterday's highs should act as support on any pullback. So at worst, the 4,000 level. Right now we're at 40.65, so 1.5% to the downside. We have our positions basically in place now, and we're going to ride this if it continues to go higher. As far as expectations for the environment or for the investing environment, various market conditions, we're right here, which is we've been correcting. We're in a bearish, and this may be the early recovery from this recent pullback. It's typical for us to have moderate underperformance at this point. We're basically flat for the week while the S&P is up 3%, but we only gave back 2 to 3% during this entire 10% pullback recently. So different market conditions that you have. I've got 8 of them broken down here, 9 of them broken down here. And we have different expectations for how the way we manage money, how it will participate. And right now, this is the moderate underperformance phase, but now we've got our positions ready next week if we consolidate and continue higher. If we fail, and as I said, break below 4,000, we'll be out with a very small loss, and that probably indicates that this 3-day move up is, at least from a short-term basis, not going to go further. So the 4,000 level, very key for next week.
That means Gary Shilling might be right and Siegel might be wrong if it goes that way. But if it keeps going up, Siegel is right and Shilling is wrong, and that's why their opinions don't matter. Because you got to follow what actually is happening while it's happening,
of course,
and make adjustments accordingly. It's a lot easier said than done. Don, can you so tomorrow, if we had a big up day, would that be considered a 4-day follow, the classical IBD 4-day follow through?
Well, first of all, that would be very surprising because tomorrow is Saturday. So I would be shocked if we had a big follow through.
Monday.
Monday. It would be day 4. Yeah, off the lows, and just because it's day 4 and we're up, it doesn't mean that it's automatically a follow through. You have to have heavier volume than the prior day, and you have to have a certain percentage gain for that to be considered a quote unquote follow through day. As is typical, we like to get a little bit of a head start on that. We're not just going to sit and wait for IBD to tell us what to do. We've got a certain way that we manage things, and it involves incremental exposure as soon as we see signals that a bottom may be in. And for now, this signal with that false undercut on Tuesday and rally off of the low over the last 3 days, that tells us that a short-term bottom is in until we get evidence to the contrary.
Yeah, so what Don said in plain English for the people that aren't quite stock nerds, 4-day follow-through rule is kind of an IBD methodology with showing probabilities when you do have a true 4-day follow-through. But a lot of times off a bottom, you can have a 10 or 12% rally or even more before that on that 4th day as it's happening, before you would actually get in. So Don's actually developed a few tools to where we can get in a little bit early on smaller pieces to get a head start with tight stops if it's a failed breakout.
IBD never officially went to market in correction during this pullback. They're still on uptrend under pressure. We went to correction on 826 in our in the tail of the tape and the videos that we do. That was just a complete change in character, heavy selling on volume. Leaders fell apart. And then we continued lower for 4 to 5 days before we put in the bottom on this most recent Tuesday. So they may not even have to say we need a follow through day. They could just go back to uptrend based on the action of leading stocks and the indexes, and leaders really have been acting well. That's something that we've been consistent about in the videos that we've been doing. I'm going to bring in the trend gauge that we use in our videos every night. Leadership never went off of neutral. How do I gauge this? I gauge it by the action of the 21 over 21 that we keep, and we just didn't see enough breaking down of the current leadership stocks that were in this 21 over 21 for me to come off of neutral. In fact, the arrow went to green last night, and we're acting pretty well today across the board with leading stocks. So now we're going to see, taking our cues from the leaders held up. Now what we're going to see is the short-term and medium-term arrows come off of bearish / downtrend and improve as we continue to get to make progress to the upside.
Were you surprised that IBD didn't go into downtrend and just stayed under market under pressure?
If you went by how leading stocks were acting, not really. But if you were looking at the way the indexes were acting, breaking down below all of the moving averages is certainly a correction. From my point of view, that's why, IBD doesn't really push buying the indexes the way we do. I've long been a proponent of buying SSO to smooth the portfolio, to have tight entries and tight stops, because the indexes should act a certain way. And then corresponding to that, 75 to 80% of stocks will do what the indexes are doing. So we like to dip our toe in the water with the SSO first, and then let the leading stocks prove themselves, instead of taking a scattershot approach across a bunch of stocks that you could have a hard negative reversal the next day and give back all your gains.
Yeah, and so in plain English, what Don is saying, that's one of the methodologies that he's devised to help get in a little bit early off a bounce and to get exposure quickly, while new leading stocks develop on the charts along with the ones that still held up. Last question, Don, do you miss Bill? You kind of miss Bill, don't you?
Yeah. There's only one Bill O'Neill. Yeah. That's for sure. Yeah. He's battling dementia. He's really not involved anymore, but
he's not making the calls.
A true legend. And I feel very fortunate to have met and spoken with him in person when I went out to some of the workshops they were having out in Santa Monica, and just an amazing individual for what he did for the investing community.
Oh, he's amazing. I still believe it. When we saw him speak here and I met him, I still think he has a photographic memory. It's unbelievable. All right, folks.
No doubt.
Yeah. Listen, Ted, welcome aboard to Revere. Thanks for coming on board. Michael, that was a great segment on uranium. Folks, listen, please have a safe weekend. If you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. They can click in that top right-hand corner where it says subscribe, and this podcast, weekly podcast, will go to their inbox directly, as well as our short daily market insight videos. They're about 10 minutes a night anytime the market is open, and we won't spam them or hassle them. It's up to them to reach out to us with questions or a complimentary portfolio review, or if they just want a topic they want to hear on the air. We're not gonna sell their email list to anybody. Anyway, you can just have them sign up. You can reach out to any of us, Dan at revereasset.com, Don at revereasset.com, or Michael at revereasset.com, and pretty soon Ted at revereasset.com. I just haven't got that set up yet.
Watch out, Ted.
You can also call us old school at 855 Real Wealth. Folks, we will talk to you next week on Your Money.
Barring any misconfusion or extraneous events.